What is a credit score? Your credit score is a number assigned to you by the credit bureau software. It has become widely accepted by lenders as a method of determining the likelihood that borrowers will pay their bills. Your credit score affects your credit worthiness based on some given statistical model depending on the credit bureau that issues it. A credit score will vary somewhat depending on which credit bureau issued the score. Most of the time, the scores from the three major bureaus will vary only slightly, but not always. A 2002 study found that 29% of consumers had credit scores that varied no less than 50 points, and 4% varied by 100 points or more. What is a good or bad score? Credit scores generally range from the mid-200s to the mid-800s. While different lenders use different guidelines to determine credit risks, here's a general idea of what constitutes a good or bad credit score. Above 730? Excellent credit. You'll be eligible for the most favorable interest rates on loans. 700 to 729? Good credit. 670 to 699? Fair credit. Your file will be more closely scrutinized. 585 to 669? Poor credit. You will not be eligible for better rates because you'll be deemed a higher risk. Below 585? Very poor credit. Creditors will need to regard other information in your application, and you may be limited by the types of credit available. The FICO score. The most well-known and widely accepted credit score is the FICO score, developed by the Fair Isaac Company. The company began its work with credit scoring in the late 1950s. Factors affecting your credit score. A credit score is based on a number of factors including payment history, current level of debt, amount owed, length of credit history, pursuit of new credit, and types of credit. These 5 factors are given different weight in calculating your credit score. This chart shows the approximate percentage by which each factor affects your score. Number 1. Payment history. As you can see, the payment history is the single biggest factor affecting your credit score, accounting for 35% of your score. Payment history includes information on your payment patterns, such as whether you made your payments on time or if payments were past due, how many accounts were past due, how often were they past due, by how much, and by how long, charge-offs, collections, bankruptcies, repossessions, liens, and court judgments. What can you do to improve your credit score in this regard? To begin with, make sure you pay all your bills on time, but just as importantly, make sure your credit report is accurately reporting this information, that all the accounts reported are actually your accounts and not someone else's, and that those accounts that are yours are being accurately reported regarding timeliness of payments, and that the reported balances on the accounts are correct. Number 2. Length of credit history. The length of credit history accounts for 15% of your credit score. Lenders like to see a long history of timely payments, but of course your credit report can't show a history of timely payments if it doesn't show any payment history to begin with. This can be the case if your account payment or credit history are not long enough. Your credit report lacks recent information on accounts. Your report has an insufficient number of satisfactory accounts. The date of your last credit is too recent. There are too few or no recent balances on revolving accounts. A young person who has never applied for credit or taken out a loan will need to establish a credit history by applying for credit and making timely payments on his or her debts. If a person has had a poor credit history in the past and needs to reestablish credit, a good way to reestablish a history of timely payments is to get a secured credit card. This is a line of credit secured by a cash deposit in a bank. By charging debts to the secured credit card and then making timely payments on that debt without maxing out the card holder may be offered a true line of credit after a period of about a year. Although the interest rate will be high and the credit line small, when one is trying to reestablish a positive payment history, it offers a means of doing so. Number 3. Pursuit of new credit. Pursuit of new credit accounts for 10% of your credit score and includes the number of recently opened accounts, how recently they were opened, the number of inquiries, how recent those inquiries were, Whenever a potential lender requests your credit report from a credit bureau, this request will show on your credit report as an inquiry. The lender is required to have your authorization to make the request for your credit report. Excessive inquiries within a 6-month period or recently opened accounts make lenders nervous. They're reluctant to lend money to someone they think might be about to get in over his or her head by taking on more debt than they're able to pay off. But again, it's entirely possible, or even likely, as we've seen earlier, that not all the new debts and/or inquiries on your credit report are being accurately reported. You can help your score by making sure the credit bureaus are not showing recent debts that are not actually yours, nor inquiries that were made for someone else's report or that have not been properly authorized by you. It's important to note that not all inquiries hurt your credit score. For instance, if you're shopping for a mortgage, all mortgage inquiries close together, for example within 30 to 60 days of each other, are considered as only one inquiry for your score. Inquiries made for account monitoring purposes, such as your current lender checking your report to offer you a higher credit limit, do not impact your credit score. If you personally request a copy of your own credit report, it will not have an adverse effect on your score. Number 4. Current level of debt, amount owed. Your current level of debt accounts and debt ratio accounts for 30% of your credit score. Included are the total debt you owe, the number of accounts with balances, the debt ratio on your various accounts. Number 5. Types of credit. Types of credit account for 10% of your credit score. Lenders like to see a healthy number and mix of different types of debt on your credit report. Different types of credit include revolving accounts. A revolving account is one in which the debt balance and minimum monthly payment are not fixed but can vary from month to month. The most common types of revolving accounts are credit cards and merchant accounts, such as accounts with your local discount store, auto service center, etc. Installment accounts. Installment accounts are those with a fixed monthly payment and a starting balance that declines over time, such as mortgage, car, and student loans. Home equity line of credit. A home equity line of credit is a kind of hybrid account. Like a mortgage loan, a homeowner is able to borrow money secured by the equity in his home. He doesn't do so up front, but rather over a period of time, usually as needed. A maximum amount is established, which then may be borrowed up to this amount by using a credit card or checkbook. Factors not considered in credit scores. The following factors are not considered in computing your credit score: age, race, gender, religion, national origin, inquiries made for account monitoring purposes, such as your current lender checking your report to offer you additional limit.